GameStop investors are once again squeezing short sellers. This stock options expert explains how it works and why more margin calls may not put them off.
I think in the GameStop original thing it was just to get to the hedge funds, definitely. It's a zero-sum game. Every winner there's a loser, and prices will go up and down, and you can make money on the downside as much as you can on the upside.
The GameStop saga that caused the mother of all short squeezes in 2021 is back in action. The stock, which is a US video game retailer, jumped last month after the Roaring Kitty posted on his Twitter account for the first time in a few years, signalling he was back in the game.
I like the stock.
Retail investors followed Keith Gill last time, piling into GameStop stock as a means to stick it to the hedge funds that were shorting the company's stock. While some investors made big money, some lost significant amounts, but none more than the short sellers who spent billions covering their bets. Melvin Capital didn't survive it. The latest squeeze caused short sellers to lose almost $1 billion in cover. The short interest on GameStop is now around 25%, much higher than the average S&P 500 short interest of 1.8%. Other stocks with high short interest include Sun Power Corp, Beyond Meat, and some pharmaceutical companies. Short selling is a type of derivative. Greg Boland is an expert in it. In this interview, he explains how calls and puts work and why a GameStop squeeze is not enough to put the short sellers off. Well, Greg, thank you so much for doing this and for having us in. Appreciate it.
Yeah, thank you. Thanks for having me.
Let's start by talking about what was the mother of all short squeezes, and we're seeing some of it again, GameStop. Explain to me what's happening with the short selling interest in that stock at the moment.
At the moment, okay. So GameStop is a stock, as we well know from our Netflix TV show, that in 2019 retail investors stood up against big fund managers who were shorting GameStop. So the big institutional investors thought that the stock would fall, and therefore shorted the stock. And the retail investors, through Reddit and various forums, got together and started buying the stock, which pushed the price up. So it was called a short squeeze because the big funds, the hedge funds, they will short the market. They will make money if the market falls. Of course, the market went up, and therefore they had to pay margin losses.
They got margin called.
Margin called, short squeeze, and therefore they had to get out of their position by buying them back at a loss, and therefore owed lots of money. And the retail investors on the other side, some of them made a lot of money, but some of them lost a lot of money as well. And what's happened recently is that there's been a post on X where it's just got GameStop and the person, allegedly, who originally did the idea of going along the stock, and that's been back in the market. And so GameStop again is to the fore, and the share price has jumped from the sort of $5-6 to $65 and back down again. And short interest in that is around 25% at the moment. So for every share that's on issue, 25% of them have been sold short. And that's compared to the S&P average, which is about 1.8%. So still a big amount, but not in the hundreds like it was last time. It's around 25% short interest in GameStop at the moment.
How are we here again with GameStop? Did the hedge funds not learn anything last time, given they're still shorting it to around 20%, obviously less than the around 100% last time, but it's still a lot.
And I don't think it's necessarily hedge funds. It could be retail investors who have shorted it. There's no reason why a retail investor in this day and age, through a platform like the one we offer, can't borrow stock from us as a broker and then sell that stock into the market. They just need to have enough cash in their account to cover the initial margin, which is for GameStop around 90%, and for most stocks around 35%. So you have to have, say you're shorting a stock at $100, you're hoping it's going to zero. You've got to have $35 in your account to cover the cash position. And if the stock price goes up by 5%, then you've got to top up with more money. So a margin call, and if you don't have enough money in and an automated system will just automatically close you out.
Yeah, this is the whole reason I wanted to come in and chat to you, Wright, because your knowledge on both short squeezing, short selling, and derivatives as a whole is kind of second to none in this market.
Thank you.
Can you explain to me the type of derivative that leads to a GameStop short squeeze,
Yes.
and how it perhaps differs to other options?
Okay. So it's basically the same. So in the United States particularly, there is stock options on individual stocks whereby you have the right to buy, which is called a call option. You're calling the stock to you, or the right to sell where you're putting the stock to someone else.
A put.
A put. And each one is on 100 shares and they are listed on most stocks in the market. So the GameStop is just another stock that has options on it. But in this case, because you can leverage and buy a call option hoping that the price goes to the moon, and if it doesn't, you only lost a small premium. A lot of people will enter into stock options hoping that the price rallies away in terms of buying a call option. And the same with a put. If they think, if a GameStop got up to $65 recently and it was 3 or 4 before that, and you shorted it either by shorting it or by buying a put option, then you make money as the price falls away.
So the money you make is that margin?
Is dollar for dollar movement of the stock. So say you shorted at $65 and you paid margin, which is around, so we'll say it's a $100 stock and you've paid $100 in margin. As the price falls, you'll make money, but if the price rises, you have to top up your $100 to $110, $120 or whatever it might be. So it's a zero-sum game. Every winner, there's a loser, and prices will go up and down, and you can make money on the downside as much as you can on the upside. And people in the markets don't understand that. Everyone thinks you just buy shares. There's no reason why you can't short sell them, buy a put option on them, or sell a call option on them.
So it's a 50-50 game, effectively, winners and losers. It's kind of like playing red and black at a casino, correct?
Well, we don't like to compare with casinos because the house mostly wins, but the market usually wins, or it wins in this situation. And so for every winner, there's a loser, or every buyer, there's a seller, and therefore it's a zero-sum game. Whereas in a casino, not necessarily everyone who's on red and everyone's on black is necessarily going to make money because the house is there to make money on the way through.
Are stock options the most popular, or at least most commonly understood and used type of derivative in equity markets?
Yes, in terms of retail investors, because each option is on 100 shares, and so even stocks like Nvidia, which is currently $1,100 put option or call option, is still going to cost you $40 or $50 US. It's not a huge amount compared to the $1,150 odd stock price, whereas a futures contract or an option on a index such as the S&P 500, the futures contract is $50 a point, and so you're controlling something which is worth far more, and that one is up. You take all the upside, but you also take all the downside. Whereas a call option, if you're buying, or put option, if a buyer, the risk is just the premium that you're paying.
Stock options are just one of 4 types of derivatives. There's also futures,
yes,
and hedging. Can you explain those other ones to us?
Okay, yeah, sure. So in terms of stock options, they're typically traded on an exchange. So the predominant one in the United States is either NASDAQ or Chicago Board Options Exchange that have been around since the 70s. And then futures contracts that typically traded on an exchange. You've got things like frozen concentrated orange juice, which is in the Trading Places film with Eddie Murphy in the 70s, 80s.
Though, of course, gold doesn't grow on trees like oranges. Clear so far?
Yeah. And that was an example of someone buying and selling futures contracts. There's also on oil, gold, silver, etc. So commodity trading is where these products came about, because farmers wanted to hedge their corn and wheat price risk. They came to market with their wheat at harvest time, lots of supply, not enough demand, so therefore prices dropped. why not supply ahead of time with a futures contract and take advantage of the high price ahead of time? So futures have been there for probably nearly 200 years, where people have hedged the risk of commodities. So those are the two exchange traded products, futures and options. And there's two others that are predominant in the financial markets. One is called a swap, and they typically are on foreign exchange or on interest rates, where a financial institution or a bank of some sort is creating a swap product, which they're then offering to a fund manager or whoever it might be, and it's just an exchange or swap of cash flows in and out, depending on whether the market has moved upwards or downwards. The fourth type of product is a forward contract, which is very similar to the payoff of a futures contract. And the forwards in New Zealand are typically, again, issued by a bank to a corporate who may want to lock in their forward foreign exchange or forward interest rate risk and lock in today's price for some future date. So the farmers producing milk, and Fonterra wants to sell milk in US dollars. It's paying the farmer in New Zealand dollars, and therefore it needs to hedge its US dollar risk in some way by entering into forwards or swaps to cover that forward risk of selling US dollars back to the banks to buy Kiwi dollars to pay for the farmers to pay for their milk.
What does regulation look like for all of these different types of derivatives? Is short selling treated differently to something like a forward contract?
A forward contract, so in New Zealand, under the regulation, under the Financial Markets Conduct Act, anyone who is an issuer of a derivative, issuing an over-the-counter derivative rather than an exchange product, has to have a derivatives issuer license. If you are offering futures that are exchange traded or options that are exchange traded, you don't need a derivatives license because the issuer is the exchange, not the broker. So the issuer has to have has a derivatives license. When you're issuing forward products, it's arguable that you should also be a derivatives issuer, and many of the banks have become derivatives issuers because they're issuing an over-the-counter product, such as a swap or a forward, to individual corporates. So, and in terms of other regulation, all regulators around the world are looking at things like cryptocurrency, short selling, all these types of things all the time to make sure there's not market manipulation and manipulation of the market in terms of price of a particular product. So, there's debate whether this GameStop thing is again a form of market manipulation where someone's pushed the price up and then short sold and made a lot of money as the market's collapsed again.
But one thing that has led to not only the GameStop short squeeze, but the Trump media company as well, is the use of social media and also the democratisation of investing, making it easier and more accessible for retail investors. We've seen that in stock options through platforms like your own here at Tiger Brokers. Where do you foresee that perhaps going in the other forms of derivatives? Will we see more democratisation there, do you think?
I think so, but in terms of the over-the-counter derivative, it's really the bank is matching what the corporate wants. So if a bank, if a corporate has to, is receiving $351,200 US, the bank can enter into a forward with that. Whereas a futures contract, Kiwi versus US, is on $100,000 lot. So you either buy one lot or three lots. If you buy four, you're over hedging. So over-the-counter products typically will be structured to what the actual client needs, whereas exchange traded, because they're all standardised, everyone knows what they're getting, and therefore they're very tradable, and it draws in hedgers and speculators and people who are looking to discover price ahead of time in terms of these products.
Anybody wanting to better understand derivatives as a whole, but also specifically stock options and shorting, what should they know?
They should work out that these are complex markets and complex products. So you need to understand and learn what they are, and if you are going to start trading in these sorts of products, systems like ours have a demo account, so you get a funny money, if you like, of $100,000 US. You can go in and practice your strategy versus live market, and do that over a month or 2 months or whatever it might be. Learn how the market works and then invest. Also attend courses. There's lots of online courses these days. Lots of people in the exchanges themselves put out a lot of information around what these products are and how they work. So learn the product. Next thing is it's really risk management. How much money are you prepared to lose? These markets can be very volatile, so you need to understand what is your own, thought process and psychology in terms of losing money, because you're not always going to make money. So understand risk and risk management, and don't go in too fast, too hard. Don't put $1,000 on red straight away. Go in and buy in a product that you understand. So, we can talk about gold futures or gold ETFs or whatever. Do you actually understand the underlying market? Do you understand what frozen concentrated orange juice is that's produced in Florida and traded in New York? Do you understand what Nvidia is as a company? Do you understand what GameStop is and how the price can move? So understand the actual individual underlying product first, and have that base so that then you can make an informed decision of where you think that price is going to move of the underlying, and then trade derivatives around that underlying product.
This is interesting because it seems like we are starting to see a disconnect between the actual underlying asset and the price action. Do you see a disconnect there?
Well, in GameStop, clearly there is. The value of the asset has been overhyped, and therefore the price has gone up, or people thinking that the price is going to go to zero, where clearly the market still thinks that the stock has got some value.
Well, Roaring Kitty would say that it does, according
yes, that's
to his
right.
thesis.
Yeah, but does it have a value 50 times above where it is at the moment? And the answer is the market is always right. People think the stock price should be $5 or $6, not $65. So there is a disconnect where social media is pushing and manipulating the price of the underlying more than what necessarily should be. And bigger assets, so think of the Apples or the Amazons and these sorts of stocks, or gold, it's a lot harder to move the price because there's so many more buyers and sellers in the market. Whereas in the small stocks like GameStop and various others, or sometimes you can call them penny stocks, the price volatility can be a lot higher, and therefore the opportunity to speculate can be a lot higher as well. So in terms of the answer, yes, there's a disconnect, but it depends on the asset. If it's a very highly valued and sought after asset, it's less likely to be manipulated in price, whereas smaller stocks, there's more risk. So therefore, the lesson for really is go into stocks that you actually know and think about, rather than what someone on social media has told you to buy or sell.
Where do you see this ending? Do you see investors eventually not using Reddit for investing advice because too many of them will get burned eventually? Or do you think that this is a real shift in retail investors wanting to stick it to the hedges?
I think in the GameStop original thing, it was to stick it to the hedge funds, definitely. And that why should a hedge fund make money out of something going to zero? Why, company's going to go bust, therefore I'm going to make money out of it. And the retail investors stood up against that. But in terms of long term, I think there's always been people talk about stocks. I remember in the 80s, 90s, everyone talked about Fletcher Forrest and various stocks, and all the retail investors were buying. There's a lot of debate, a lot of thought in the financial markets. Those have been in markets a long time. When retail investors talk about it, sell it, because there's no longer any upside, because the retail investors are all now jumping in, and the price might move up a little bit more, but more experienced investors probably will short the market when more retail investors are talking about things. And that's happened for years, not just on social media, but in markets of old as well.
Bottom line, the short sellers aren't going anywhere, are they?
They will be there. They will make money, and markets are better for having people who want to buy and people who want to sell. If you want to buy, Nvidia at a price, you need a seller on the other side. So whether that person is shorting or whether they already, bought Nvidia a few years ago at $50, is now $1,100. they're still there. So you need buyers and sellers in the market. How they get there, either borrowing money to buy the stock, so doing it on margin, on leverage, or borrowing the stock from someone else and shorting it. There's still market forces of buyers and sellers getting together to buy and sell particular assets, and that's what markets are about.
Yes, they are. Thank you so much for your time, Greg. This was fascinating.
Thank you. Thank you.
Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.